Portfolio Builder members, we made a fortune betting on inflation this year. And now it's time to get rich betting on deflation for 2022, 2023. We're getting ready to pull off our last inflation hedge in the next several weeks to months. And this should help generate some really nice returns. So far, our total return year to date in the high risk portfolio is up 47.84%. Last year, our total return in 2021 was a staggering 233.8%. Let's take a look at one unit of investment with our current strategy. Now, our members all follow this exact ratio of shares. So we all get the exact same return over time. Whether you have 1 unit or 10 units makes no difference. And once you become a paid member, you'll have access to the membership software where you can punch in your total to invest, and it'll automatically do the math and print out exactly how many shares to purchase. Currently in our portfolio, we have 3 defensive positions, which are in pink, and 3 offensive positions, which are in green. On the defensive side, we have 19 shares of the crash insurance ETF, UVXY. That's 19 shares, and it's coming in at 2.6% of the portfolio. Now, again, we're not chasing a percent of the portfolio to be long UVXY. We're tracking a ratio of shares. Right now, that's at 19. So we're not super worried about a big stock crash at this moment in time, but we have ample insurance in case things hit the fan. Next, over the next 3 years, we're expecting essentially for inflation to fall and for interest rates to fall. So we have 36 shares of the long end of the US government bond market, leverage times 3 with ticker TMF. This is coming in at 15.8% of the portfolio currently. Next, we took profits on Boyle. This is the 3rd time we've had huge profits on Boyle, and we rotated it into a leveraged position, betting that the dollar will strengthen against the euro. And boy, has that been playing out beautifully this year as the dollar continues to crush everything in its sight. I don't want to be in this position for long. In fact, we're getting ready to short natural gas with the EUO position. I'm anticipating this will be in about 3 to 6 weeks. So right now we have 14 shares of EUO, the dollar versus the euro, coming in at 18% of the portfolio. If you don't have EUO, being long the dollar's very similar position. So that's our defensive plays. Now, if we move on to the offensive plays, we have the first play with Ethereum using the Grayscale Trust. This is a easy stock you can buy in your stock brokerage account through the Grayscale Trust, ticker ETHE. This is our single largest position in the portfolio, and I believe we're going to be holding this for about 2 to 4 years and be able to make an extremely large return, probably about 5 times return minimum in this cycle. So 57 shares of ETHE, this comes in at 28% of your portfolio. We'll go over what Ethereum is. Most of you know it's a cryptocurrency, but it does a lot more than Bitcoin. We actually think Ethereum can overtake Bitcoin's market cap and become the largest cryptocurrency in the world in this cycle. We'll talk more about why when we get to that section of the presentation. 57 shares of ETHE. Now, again, this is per unit. Each unit's coming in at a total cost of $2,577. Next, to diversify our growth play, we are long 27 shares of ticker FNGU. This is 12 gigantic tech companies who have monopolies in their respective marketplaces. They've been growing for decades and they're going to keep growing. We have 27 shares of this, leverage times 3, and it's a 10% allocation. This is one of the only tickers that can keep up with the return of ETHE. They're extremely correlated. With the 3 times leverage in FNGU, it does do a good job of getting a similar return as ETHE. Next up, our last inflation hedge, which we could be holding potentially longer. It depends on what's happening with the war. We've got a lot of content on this, but The Middle East is making damn sure oil doesn't go below 100. So we could be holding NRGU for longer. These are the 3 times big US oil gas companies. One share comes in at 20% of your portfolio. If you've been following the news, Warren Buffett is on track to take over 50% of Occidental, one of the stocks that you get 3 times exposure to with NRGU. And he's a long-term investor. He's using that to hedge his huge tech play in Apple. So we'll have to see how this war plays out in terms of how long we're going to hold NRGU. And I got a lot of commentary on that. Now, if you're watching this on YouTube and you're not a paid member, you're going to miss the trade alerts when we tell you to sell and buy, because you get all this content delayed and you only get a portion of it. So call Dean now to upgrade at 505-322-7515. And most important, you're going to gain access to the membership area where you can type in how much you want to invest, and it'll automatically calculate the exact number of shares to purchase. Okay, so let's go into the data. We need to realize there's a massive amount of cash on the sidelines. As soon as it's clear inflation has peaked and is falling, we're going to see a lot of things happen. One, we're going to see the Fed stop being so hawkish about rate hikes and quantitative tightening. 2, we're going to see all this cash rush into financial assets. And then 3, China will finally be able to print trillions of dollars to secure their housing market and stimulate their economy ahead of new elections for President Xi. So this is very important. They cannot get away with printing lots of stimulus in China until inflation's rolling over. Otherwise, their yuan would get crushed, like we've seen with the euro and the yen in the recent year. So step 1, buy 19 shares of UVXY. This is the stock crash insurance hedge. This thing rarely goes up unless there's a big black swan event. So most likely what would cause a big problem in markets right now would be for the war in Europe to escalate aggressively, for NATO to go after Greece, China, and India, who are helping the Russians bypass all the sanctions, which could end up causing oil to skyrocket to new highs. That's probably the only thing I see that would cause inflation to start running up again, and would most likely cause a huge meltdown in the market. In 2020, when stocks went down 25%, UVXY went up 1,000%. If you'd had 10% of your portfolio long UVXY, that 10% doubled your total value of your entire portfolio. So it's a beautiful product in the right circumstances. We got to realize when DXY goes to this level, a lot of crises have developed. It's very important that the dollar index goes down and that inflation is falling. Otherwise, things could get pretty ugly quickly. So we're ready for it. This chart shows you also the dangers of a market crash during a rate hike cycle. And often it can end up with a crisis. Now, this chart's not showing you all the times the Fed has pivoted and saved the market before a big crash. And we're heading into midterms. So if you believe the Federal Reserve is politically motivated, they're likely going to let this inflation run a little hot through midterms this November. This chart reminds you of some not so hot times in history over the last 120 years where the stock market didn't just go up. Okay, so you have the early 1900s leading into World War I and II. You got the Great Depression, and then you got the inflation of the 70s. We're not anticipating that right now, but it's good to know your history. And again, if this war continues for a long time, it could drive more inflation. This is a neat little chart I found. It says a roadmap for how the economy responds to changes in rates. First, the housing market slows, then new orders slow, then profits slow, and then the last to react is the employment. So we got to ask ourselves, are we seeing the signs that inflation is cooling off? And so in this chart, we're looking at the latest CPI. We can see what was dragging it higher predominantly in pink. Energy has finally rolled over. JP Morgan's Marko Kolanovic says inflation will resolve on its own as distortions fade and likely drive a Fed pivot. A stronger H2 recovery in China should provide support for the global cycle. In combination with still very low investor positioning, it creates a positive environment. In this chart, we're looking at U.S. manufacturing and services PMIs heading straight down, which we've seen predicted via China and Europe's PMIs going below 50. Now, this is from BlackRock with Rick Ryder with the prediction for the September meeting Fed announcement. I'm thinking they're going to come in at 50 basis points, but he's thinking 75. If they do 75, I would expect 0 come November. But Rick Ryder says, and while data dependency continues to be the key watchword for FOMC, it's likely to hike the federal funds policy rate by 75 basis points in September for the 3rd time in a row. This will bring the policy rate range to 3 to 3.25, which should be seen as the beginning of moderately restrictive levels. And this Friday at Jackson Hole at 10 a.m. Eastern, Powell will be giving a speech, perhaps with some hints as to what's going on in their head. But the housing data is telling us they've already done the job. They don't need to over tighten. July new home sales crashed 12%, a much bigger fall than expected. Year over year sales have collapsed 29%. The supply of unsold new homes is at the highest since March of 2009. This is looking at the change of interest rates and mortgage payments. To sum it all up, interest rates have doubled, and the average mortgage payment has gone from $1,300 a month to $2,500 a month. Monthly supply of new houses is hitting levels last seen in 2008. The new home sales year over year is collapsing, not as bad as we saw in 2007 and 8 and 9, but it's headed that way. If we look at building permits, purchase applications, new home sales, and the housing market index, they're all falling off a cliff. So the regression model based on lending rates is signaling we could be seeing a decline in housing prices by 10 to 15%. Rate of change for new home family sales has a huge drop, down 39%. So as far as the leading data is telling us, they've done the job. They really are set up to slow down this hawkish talk. So we'll see if that starts to be demonstrated at the Jackson Hole Friday, and then the end of the month, the decision in September. United States core inflation rate fell from 6 to 5.9. We want to see this keep falling for the Fed to pivot. Job openings are starting to fall. We know one of the sticky parts of the inflation print has been hourly earnings. But again, job openings are now starting to fall, and layoffs are being announced at all the major corporations. The other sticky print was rent inflation, but again, another lagging indicator. We're seeing the housing market really dramatically cool off and fall. This chart's looking at jobless claims and initial jobless claims, again, starting to pick up and rise. On the gasoline front, this has fallen significantly, and perhaps what the voter is most interested in is that falling gas price. As long as that's falling, perhaps we get a dovish Fed. Truckload index also falling. This is what was eating away the profits for Amazon for much of the year. And now used car prices are also starting to cool off and fall. Container shipping rates have been falling all year, and retailers are full of merchandise, the bullwhip effect. They had too much demand, over ordered, and then the demand died. Now they're gonna have to discount these products and get them off the shelf. So let's take a look at the charts. Here's TMF. It's been trading down 19% in the last 3 months. This means interest rates have been rising over the last 3-month period. And the big gain we saw in the bond market from June 13th to the top of August, or the start of August, has almost all been given back, driving TMF from 14 down to 11. Long term, we believe these interest rates must go lower, meaning TMF must go higher. I think it's going to go for about 3 to 4 years in this cycle. So TLT is the non-leveraged version of TMF. We're likely going to flirt with recent highs. So that's really how the government grows its debt. And there's a lot of reasons why these interest rates must go lower for the entire financial system to continue operating. Any lower than 108, which is one of the lows we saw this year, and things will break. So we're keeping a close eye on it, but I anticipate this is getting ready for a strong bounce. Here's the TLT over a 3-month period, down 6%. Now, if we look at the corporate bond market, this had been recovering for a month and giving back only half the gains. With the investment grade corporate bond LQD, the high yield bond market has given up less than the investment grade. So while we're seeing the pullback in bonds, not looking too bad at this point. Probably the most problematic continues to be the front end of the bond market, which is now inverted. So we have an inverted yield curve. Short-term interest rates are above long-term interest rates, meaning the Fed is overdoing the tightening and signaling that they need to pivot. This 3-month interest rate has gone parabolically up at the fastest pace in history, and that's why we've had so much pain. This is now at 2.7% and has risen 160% in the past 3 months. We really want to see these cool off, and they likely won't until it's clear inflation has peaked and is rolling over, and that the Fed is going to stop hiking those short-term interest rates. The 2-year back up to 3.34. If Rick Ryder is correct, then one more 75 basis points would get us right under this interest rate and perhaps calm the 2-year. While this had fallen to 2.8 at the start of August, it's jumped right back up to 3.4, increasing the odds of a 75 basis point rate hike. Here's the 10-year chart. You can see we are way above the trend where this can start breaking things. Now the 10-year is up 12% over the last 3 months, while the short end is down. So this is where we're getting that inverted yield curve, signaling the Fed is overdoing it, is going to cause big problems in the economy. 30-year painting the same picture. It's way above trend. This needs to come down immediately. And again, it's up 9% in the last 3 months. So the long end is saying if the Fed keeps this up, you're going to crash everything and make the long bond very attractive. Now, what about in Italy? This was a very problematic bond market. Not as bad as some of the short-term bonds in the US, but posting a similar return as the long bond in the US. Lumber futures, while up considerably compared to the last several decades, is down 59% year to date. So lumber futures, which had been leading the inflation higher, is down 59%. Copper futures up dramatically from historic levels, but also down 17% year to date. Baltic Dry Index slightly up with historical data, but again, down 44% year to date. This is the cost to ship commodities between continents. Wheat futures, which should be sky high with the supply being shocked with the war in Europe, has also fallen 30% over the last 3 months. So everything's cooling off. There's very few inputs that would continue to drive the inflation higher. Here's where we're standing at inflation currently at 6 on the core. We've got the PMI pointing straight down. Consumer sentiment is at levels last seen in 2008, even worse. Typically a great time to buy the dip. The consumer always thinks whatever's happened recently is just going to get worse and worse and worse when perhaps we are at the worst. Jobless claims has gone down slightly week over week, but you can see the trend is that jobless initial claims are rising. And the yield curve remains inverted. And this is again signaling that the Fed should slow down these rate hikes. Here's a look at the yield curve over the last year. And again, it went from positive territory to negative in about July. So that's why we believe you should be a long-term holder of bonds. Step 3, buy 14 shares of EUO quantitative hedge. If we're going to really start jacking interest rates higher and do aggressive quantitative tightening and not worry about what the hell happens to markets, DXY could go dramatically higher. Europe is in no position to do rate hikes. They're already having negative 11% GDP, and China can't do any sort of tightening. Their real estate market is crashing at negative 30% sales year over year. So this puts the dollar in a position to skyrocket higher if the Fed tightens while China, Asia, and Europe are all weakening. This is the DXY over the over the year to date, up 13%. Our product, EUO, is up 30.1%. Now, again, the main catalyst that resumes, that continues to drag inflation higher is the war. And I want to rotate this into shorting natural gas, which is at levels that are unsustainable for the European economy. Now, the bad news is it looks like Russia is getting ready to get very aggressive and make a final push before perhaps a truce can be made in the end of September or early October. At that point, we want to sell EUO and short oil with ticker KOLD, and you'll need to be a paid member to get that signal. Here's the dollar going above parity against the euro. So the euro has devalued 14% against the dollar this year. The yen is devalued 18% this year against the dollar. And the yuan from China has devalued 7%. If you're wondering why China has been waiting to do massive stimulus and bail out their housing market ahead of these key elections, it's because they don't want their currencies to devalue, because they need to be able to aggressively import goods such as oil, coal, and steel to fuel their economy. So as soon as the Fed pivots to be more dovish, China can follow suit and do massive stimulus. This will be very good for our portfolio. Only currency outperforming the dollar dramatically is the Russian ruble, up 26% compared to the dollar this year. Here's a look at the Fed's balance sheet. They're saying they're going to sell $3 trillion of bonds slowly but surely. So we'll see if they really do that or not. But this is going to be removing liquidity from the markets. So we need to be careful and observe how this affects markets. And the same thing is supposedly going to happen in Europe. Step 4, buy 57 shares of ETHE. If we believe interest rates are going to go down and the markets aren't going to fall apart, this is the position we think will make the greatest return with the least risk. There is Vitalik, the funny guy who created this blockchain. And here's some predictions for Bitcoin coming into this cycle. And again, it's essentially reducing the return by about 500% each cycle. It's predicting we could see Bitcoin head towards 140 to 200,000 with a 3.6% return. I'm thinking we're going to make about double that with Ethereum and potentially get very close market caps if Ethereum doesn't even overtake it in this bull cycle. Raoul Paul says, the old cheeky pre-merger crypto shakeout I see. I don't expect new lows, but most likely a gut check, quick drop. But let's see. New lows equals keep adding for me. 2-year risk reward gets really, really attractive. 50% downside versus 10 times potential upside. 20-to-1 risk ratio. Now the merge is going to essentially remove about $18 million of selling pressure from miners. It's going to reduce the supply, and it's going to encourage buy and hold investors with a 5% staking fee. And in this chart, we can see the big wallets have been aggressively buying Ethereum this pullback. Perhaps they wanted the pullback to steal all your Ethereum for cheap. This is what's breaking down the math, but essentially by moving from proof of work to proof of stake with the merge, the supply side is going to shrink. The selling pressure is going to go from negative to positive. And this should be very, very bullish long-term for Ethereum. Now, it's been a rough year for cryptos, and this is a little joke, but Bitcoiners will live like this to buy an extra $100 worth of Bitcoin each month. Got Michael Saylor on the TV with a blow-up bed and a few beers. BlackRock has now partnered with Coinbase, showing the big money's moving in. This looks at the timeline to adopt technology. And so you can see it takes several decades. Bitcoin has barely become adopted. Very few people hold Bitcoin. So a long ways to go. We're just getting started. Other signals to believe this is a good time to load up on Ethereum. As the Bitcoin went under its 200-week moving average, only happened 4 times in history, and has led to big melt-ups. RSI went to a level only seen 2 times in history previously. We had the worst month ever and the worst quarter, so buy the dip. And we look at the dividend yield by S&P 500 sector. Ethereum is about to have a greater dividend than any other asset class with growth potential that blows away these sectors. at a 5% staking reward. Here's a look at why we like cryptocurrencies in general. The whole world is addicted to debt. If they don't keep growing the debt, everything falls apart. That's the main driver. Here's the US federal budget's deficit projections over the next decade, growing from $1 trillion deficit this year to $2.3 trillion by 2032. That's all we need for this to continue growing. And that may be underestimating how much the government's going to try to weasel out of the American taxpayer here and have the Federal Reserve end up printing. And we can see it took 215 years to grow 7 trillion in debt and only 2 years to add an extra 7 trillion after this whole lockdown madness. So here's the chart. You are getting in at very low prices relative to highs. We recommend buying the dip with ETHE. Today it's at 1272. Now, I want to let you know, if you are a paid member and you want a leveraged position in Ethereum, plus get all the software applications being designed on the Ethereum platform, also with leverage, you can take that position and give it to our company, Rebel Dividends, and we will give you a weekly dividend and a leveraged position. It's designed to replace your ETHE position. If you're interested in that, call Dean at 505-322-7515. Again, legally, you must be a paid member. We're only allowed to have up to 35 non-accredited investors, and that's filling up quickly. Step 5, buy 27 shares of FNGU, the 3-time tech giant play. The recent melt up we had was from short sellers having to cover. It was a beautiful melt up. We gave back some of that Monday, but the market's starting to sneak back up. And guess what? The short sellers are coming right back. They think Powell is going to crash the stock market before midterms, as all the leading indicators show that inflation is falling on its own. I don't buy that. So there's now $125.7 billion short the market, getting ready to be short squeezed, perhaps as early as this Friday. If Powell makes it crystal clear, we're going to slow the hawkish talk. Live Monitor says the market and economy is weak. Congress will likely try to pass one more stimulus bill before the House switches to GOP control, delaying quantitative tightening until February. We'll see, but that could be very bullish. And again, here's that massive short position getting ready to be squeezed. Midterm years tend to bottom later in the year and see larger corrections. From the bottom, the average return 1 year later is 33%. And we're using 3 times leverage. So you're looking at more like 100% return from here if this trend continues. Market corrections in past, if you bought at exactly the bottom, and who knows if we're at exactly the bottom, I do think we've already hit it and are, of course, back on the way up. The average return in 5 years is 110%. So here's the ticker FNGU. It fell from 45 down to 8, and it's currently at 991. A screaming buy, and you can get in with leverage. Over the last 3 months, it's up 37%. Now let's look at some general indexes. If you're in our safe growth strategy, it's on target to get back to even soon here. It's doing really good this month, up 7%. The S&P 500 is now down 11% year to date. The NASDAQ is now down 17% year to date. Emerging markets down 18. This chart shows the underperformance or overperformance of EEM. And so there's been a few periods, one leading up to 2008, where emerging markets dramatically outperformed US markets. In our safe growth strategy, we have a position in that. And I do believe as the war comes to an end and the CPI falls and China stimulates, we're about to see that great outperformance. It could be 2, 3, 4, 5 times outperformance the S&P 500 as the DXY index falls. Europe, we're keeping a close lookout, make sure it's not crumbling under our eyes, down 19%, but similar return as the other indexes. Uranium, which is a position in our safe growth play, is actually up while all the other indexes are down over this week over week period, up 10% today alone. Rare earth metals were long in the safe growth strategy. This is how you get lithium, another inflation hedge for the tech giants who want batteries, also up week over week. Some individual stocks we're keeping a track of. Amazon down 17% on the year. Apple down 3% on the year, but has made back a lot of its losses. Alibaba in FNGU. Again, this is down 28% year to date. We just had Ray Dalio exit this and Buffett, but I think this is a good time to buy as it went from a value of 400 down to 90. So it's at such a depressed level. Now, this is going to be important for the Powell pivot, as we would like to see payroll start to slow down. So we had a hot print last month. We'll see how that comes in. Almost all these jobs were part-time jobs. We actually lost full-time jobs. So people are struggling and taking on 2 jobs to make ends meet currently. Bank credit continues to grow, showing a healthy economy. United States consumer continues to grow credit, keeping those retail sales. After a slowdown, we had another jump. We just hit a new high in consumer spending. Balance of trade is still negative and healthy, so we're exporting dollars and importing goods in the US. New home sales, while falling, are still at decent levels. China's PMI, which went to nearly 35 as they locked down the country to fight inflation, has jumped back up as they reboot their economy. And they're yet to put a lot of stimulus, and again, because they're trying to protect their currency and wait for the US to pivot. China's exports are red hot, nearly at record levels, showing global economy is still operating fine. And here's why China's got to be careful about their currency, because they have to import so much goods, 233 billion. Step 6, buy 1 share of NRGU, the inflation war hedge. This is the most profitable company in the world, Saudi Aramco. And they just made sure the price of oil stays steep by saying they're going to produce less as the US tries to drain its strategic petroleum reserve. So we could be in this position a lot longer. Temporarily, I would get out if we saw a reversal in sanctions and some sort of truce in the war. And I'd also want to short Boyle natural gas with ticker KOLD. For now, it's the key inflation hedge in both portfolios. And their profits in the last quarter were greater than Tesla, Facebook, Apple, and Microsoft combined. Okay, so here's a look at EU natural gas at 501, US natural gas at 167, and then the bigger driver, crude oil, which has been falling. And so this is very important. The second the war has a peaceful period, these natural gas prices are going to plummet. And we want to short that for a huge, huge quick profit. Buffett to buy up to 50% of Occidental versus current 19% stake. And again, we can see the leading indicators are showing deflation. We got gas falling to 383. We've had a huge amount of consecutive days of gas falling, 68 days. Javier Blas says oil market after several weeks of smaller than expected SPR drawdowns. The DOE data shows a massive 8.1 barrels released last week. If confirmed, it would be the largest ever weekly SPR drawdown. It's quite a statement from Saudi Arabia just a month after the US President Joe Biden traveled to the kingdom. Not only Riyadh boosted output far less than the White House hoped, but now the Royal Palace is talking up the oil market, flagging potential output cuts. Breaking. Saudi Arabia talks about cutting production with Brent oil hovering around 95 a barrel. Europe appears to be getting worn out of the war. I don't think they can sustain this for much longer. It looks like what we had in this week is the US is sending $3 billion, but it's not for short-term expenditures. This is for long-term defense. Germany's just chipped in $500 million. Most of Europe's giving nothing. And it looks like what they want to do is just scare the Russians that it'll be too costly to go indefinitely and to try to get them to quit while they're ahead and allow Ukraine to guard whatever territory they have left. I'm still hopeful we're going to see some peace talks before winter, because if not, Europe is going to be in a huge problem, because Russia can easily cut off all natural gas and cause Europe a severe amount of pain without affecting their main income source, which is oil. And if they start to go after Greece, China, and India, who are helping Russia bypass all the oil sanctions, what's going to drive oil back to 150. So that remains our key risk and my main focus, trying to see how this is going to play out. But yeah, the costs are just crazy. A 10-minute shower in some of these countries is costing $20. So just completely ludicrous. Here's a look at household electricity prices, up 60% in the UK, 30% in Euro, and the US is only up about 15. Here's who's helping bypass the sanctions. So if we start to hear the US going after Greece, China, or India, we know we need to get worried about oil prices going up. China can't afford it. This is from Kyle Bass. China can't afford to have the renminbi melt down, also known as the yuan. Contrary to popular belief, Communist Party needs a strong renminbi to purchase the oil, gas, food, and basic material that it desperately needs each and every day. So that's why they're waiting to stimulate until the US pivots here. Here's the drawdown. This is going to end at elections. So again, long-term NRG looks very attractive, especially as long as the war keeps marching on. Here's a ticker of NRGU. We played this all of last year, got out with a massive profit, bought the dip back in July, and we've been holding it. So we're up big, and we'll get ready to pull some profits here at the right time. 45% return just in the past month. And this was your single largest position in safe growth at 30% of the portfolio. Here's the companies you get in that: Conoco, Chevron, Devon, EOG, Marathon, Occidental, Phillips, Pioneer, Valero, and Exxon. Here's a look at that oil price. Again, it's up there and everybody's doing exactly what it needs to keep it high. Here's a chart of Exxon, near all-time highs. In the last month, it's up 9.5%. Okay, very good. So this is where the video ends. If you're not a paid member, you better call Dean to upgrade. And I'm going to cut you off. The next part is only for paid members. And so to catch that part, call Dean to upgrade at 505-322-7515.